43 billion selling 28 tons of gold, 39 trillion debt about to explode. Welcome to one of the most bizarre days in the history of the gold market. Russia just dumped $43 billion worth of gold, bringing its total holdings to the lowest level since the war started in 2022. The internet is losing its mind right now with people screaming that the $5,000 gold dream is completely dead. But data does not lie. That 28-ton sell-off represents only about 1.2% of Russia's total gold reserves. It is barely a drop in the bucket, so are other central banks going to follow suit and crash the market? No. Because the truly terrifying story is not Russia. The truly terrifying story is a massive $39 trillion mountain of debt where interest payments are now officially outpacing national defense spending. Donald Trump just shattered a 40-year precedent by holding the inauguration for the new Federal Reserve Chair Kevin Warsh directly inside the White House. And that happened for one single reason: to force interest rate cuts and keep the system alive. So what does this entire macroeconomic chess match mean for gold and your portfolio? Let me give you the bottom line right away. The Russian gold sale has absolutely zero fundamental impact on long-term gold prices. The real variable you need to watch is the Federal Reserve. On one side, we have physical gold trickling out from stressed nations, while on the other side, we have global monetary policy standing on the edge of a massive shift. Gold is caught right in the middle, and the key is figuring out exactly when the real buyers will start stacking orders at the bottom. Let us break this down layer by layer. First layer, how much did Russia actually sell and why did they sell it? Bloomberg just reported that as of May 1st, Russia's gold holdings dropped by about 900,000 ounces compared to the beginning of the year, bringing their total down to 73.9 million ounces, which is their lowest level since 2022. If you calculate that based on recent global gold price averages, this reduction amounts to roughly $4.3 billion. That sounds like a massive, terrifying number when you see it in a headline, but you have to look at it in context. Russia still holds over 2,305 tons of gold, ranking 6th in the world right behind the United States with 8,000 tons, Germany with 3,000 tons, and China, Italy, and France all sitting around 2,000 tons. That $4.3 billion sale is a tiny fraction of their total stash. More importantly, this was a steady linear liquidation over months, not a panic-driven dump into the open market. So why did they do it? The answer is incredibly simple. It is not because they are bearish on gold, it is because they are running out of cash. The war has been dragging on for over 3 years. Europe has severely choked off Russian energy revenues through intense sanctions, and oil and gas export incomes have shrunk significantly, but military spending cannot be cut by a single dime. According to official data, the Russian Ministry of Finance has been systematically liquidating gold and foreign exchange assets from its national wealth fund to fill the massive budget deficit caused by falling energy revenues. The central bank's reduction is essentially a mechanical operation to help the Ministry of Finance convert assets into liquid cash, using a mirroring mechanism to hedge transactions in the domestic market and stabilize the ruble. To put it plainly, the central bank did not wake up and decide to sell gold because they lost faith in the asset. The Ministry of Finance needed cash, and the central bank was called in to liquidate the family silver. There is a critical timeline here that you absolutely must understand. The Russian central bank largely stopped buying gold in early 2020, but the full-scale conflict in Ukraine did not begin until February 2022. This means that as early as 2020, the Russian central bank was already hoarding cash and adjusting its reserves for this exact conflict. For 2 years, they bought up almost the entire domestic production of mined gold. What does this tell us? It tells us that this geopolitical move was planned long in advance, and once the conflict actually started, the central bank obviously could not keep buying gold on a massive scale, because every single dollar had to go into the bottomless pit of military expenditures starting in 2024. Russia began this continuous linear selling because the military bills got too high and the ruble depreciated too fast. They had to sell gold just to stay afloat. Second layer, is this an isolated incident or a broader global trend? A lot of retail investors see a headline about Russia selling gold and immediately panic, thinking global central banks are about to dump their reserves and run for the exits. Let me tell you right now, that is not happening. This exact operational playbook has played out before multiple times. Let us look at Turkey. In 2024, the Central Bank of Turkey also liquidated gold on a massive scale, cutting its holdings by more than 100 tons in the first half of the year. The reason was exactly the same. The Turkish lira was collapsing, foreign exchange reserves were completely depleted, and they were forced to sell gold to buy US dollars. Just to keep their economy breathing, the market panicked back then too, with people shouting that gold was going to crash to zero. But what actually happened? Gold prices did not crash at all. They kept marching straight up. Why? Because institutional markets saw exactly what was happening. Turkey was forced to sell out of weakness, not because of a strategic bearish view on gold. Look at Poland. The National Bank of Poland also trimmed its gold reserves due to intense domestic fiscal pressure. Poland needed to aggressively expand its military infrastructure to respond to security threats from the regional conflict. When tax revenues fell short, they tapped their gold reserves. But Poland's selling volume was tiny compared to Russia or Turkey. leaving virtually no dent in the global macro landscape. And then there is the country that almost everyone misinterprets, China. According to data from the World Gold Council, the People's Bank of China saw its gold reserves peak at 2264 tons in late 2024, after which the official numbers showed no changes for several consecutive months. The mainstream media immediately started speculating that China was done buying and that the gold bull market had topped out. But if you look underneath the surface, China did not stop its long-term accumulation strategy. They simply paused buying at record high prices. A massive 2264-ton base does not move overnight, and minor short-term fluctuations do not threaten the broader macroeconomic trend. When you piece all these case studies together, a crystal-clear pattern emerges. Every single central bank that sold gold did so for the exact same reasons: fiscal pressure, war expenditures, and severe domestic currency devaluation. Not a single central bank sold because they thought gold was a bad asset or that it was bound to drop. This is completely different from retail investors' panic, selling their portfolios during a market dip. Now look at the other side of the ledger. Are global central banks as a whole buying or selling? The data shows they are buying at an absolute historic pace. According to the World Gold Council, global central banks' net purchases of gold reached 244 tons in the first quarter of 2025 alone. For the full year of 2024, total central bank gold buying topped 1045 tons, marking the third consecutive year where net purchases exceeded the 1,000-ton threshold. This is the second highest annual purchasing volume in recorded financial history. This means that while Russia, Turkey, and Poland were forced to liquidate portions of their reserves to pay immediate bills, countries like India, China, and various Middle Eastern nations were aggressively buying up every ounce they could find. Global central banks remain massive net buyers of gold, not net sellers. India's central bank added over 70 tons of gold, maintaining its position as the second largest central bank buyer globally. Over in the Middle East, oil-producing nations like Saudi Arabia, the UAE, and Qatar are continuously increasing their gold allocations with a very clear strategic objective: de-dollarization. They are systematically shifting their excess fiat reserves away from paper US dollars and into physical gold. So on one side of the world, you have a few nations under extreme fiscal distress selling gold for survival, while on the other side, you have a massive coalition of wealthy nations hoarding gold for the long term. This reality proves that the institutional consensus on gold has not changed at all. The only thing shifting is the individual financial health of specific nations. This brings us to the third layer. Why is this happening right now at this specific moment in time? Why did Russia choose to finalize these liquidations right as a massive institutional drama unfolded across the Atlantic? Donald Trump personally hosted the swearing-in ceremony for the new Federal Reserve Chairman Kevin Warsh inside the East Room of the White House. Let me explain exactly how unprecedented and strange this is. Since 2018, the Federal Reserve Chair has always taken the oath of office inside the Federal Reserve headquarters itself. The president typically does not even show up to the event to preserve the optical illusion of central bank independence. The last time a Fed chair was sworn in directly at the White House was all the way back in 1987, when Ronald Reagan oversaw Alan Greenspan's ceremony. That was nearly 40 years ago. This time around, Trump did not just attend, he moved the entire event out of the Fed and into the White House East Room, rolling out an absolute red carpet with Supreme Court justices, cabinet members, and business leaders in attendance. This extraordinary treatment makes the White House East's intentions blindingly obvious. They are applying immense psychological and political pressure on Warsh to aggressively slash interest rates. Why? Because the United States government is running out of fiscal options. The U.S. federal debt has officially breached a staggering $39 trillion, and the annualized interest expense on that debt now exceeds the entire national defense budget. Trump is pushing for sweeping tax cuts and massive domestic fiscal expansion. Where is that money supposed to come from? The only way to finance this economic plan without triggering an immediate sovereign debt crisis is for the Federal Reserve to aggressively cut interest rates to lower the government's borrowing costs. Pressuring Warsh is not a casual political hobby for the administration. It is a matter of fiscal survival. You might argue that Kevin Warsh has historically been known as a monetary hawk, someone who is traditionally cautious about inflation and prone to keeping policy tight, and that he might just ignore the political theater. That is true. But the relationship between a Federal Reserve Chair and a sitting president is never set in stone. It shifts constantly based on macroeconomic pressure. A Fed chair can be turned into a functional puppet of the administration, or they can become the ultimate institutional adversary. The critical factor is not the personal ideology the chair holds when they walk into the job. The critical factor is whether they possess the institutional spine to withstand immense pressure from the executive branch. To understand exactly what Warsh is facing and how this will impact the markets, we have to look at the history of how past Fed chairs handled the exact same pressure since the 1960s. We have seen 8 major Federal Reserve chairs, and looking at their track records gives us a clear statistical probability of what happens next. First, we have William McChesney Martin, the longest-serving chair in history who spanned 4 different presidents over nearly 2 decades. Martin famously declared that the Fed's job was to be the chaperone who orders the punch bowl removed just when the party really gets going. He flatly refused to act as an agent for the Treasury Department and single-handedly built the modern institutional moat around the Fed's independence. Second came Arthur Burns during the Nixon administration. Burns completely capitulated to political pressure, doing exactly what Nixon demanded to keep the economy artificially juiced for elections. The Fed's independence completely collapsed under his watch, making him the most famous institutional failure in economic history, which directly triggered the brutal runaway stagflation of the 1970s. Third was G. William Miller under Jimmy Carter. Carter did not actually pressure him heavily, but Miller simply lacked the competence to fight inflation, misjudging the macroeconomic data until the economy spiraled out of control. He did not break under presidential pressure. He broke under his own analytical weight. Fourth was Paul Volcker, the absolute gold standard of central bank independence. Volcker stepped in and immediately pushed interest rates to the highest levels in modern history, deliberately forcing a painful economic recession and massive unemployment to break the back of inflation. When Ronald Reagan's White House demanded rate cuts, Volcker completely ignored them, focusing entirely on long-term stability regardless of what the politicians thought. Fifth was Alan Greenspan, who managed to maintain the Fed's independence while simultaneously crossing the line into politics by actively endorsing specific fiscal tax cuts, blending his immense personal prestige with structural policy in a way no predecessor ever dared. Sixth was Ben Bernanke during the 2008 global financial crisis. While he worked hand in hand with the White House to prevent a total systemic meltdown, he explicitly and publicly defended the Fed's boundaries in front of Congress, ensuring that emergency monetary policy remained free from permanent political control. Seventh was Janet Yellen, who maintained a quiet, strictly disciplined institutional stance, keeping her head down and ensuring that monetary frameworks remained detached from political cycles during a period of relatively low public friction. And eighth was Jerome Powell, who faced the most intense, relentless public attacks of any modern Fed chair during Trump's first term. Through Biden's administration and right into the current political cycle, Trump threatened to fire him, challenged his legal standing, and publicly blasted his rate decisions on social media. Yet Powell held the line, refusing to capitulate and cementing the defense of Fed independence as his core historical legacy. So look at the historical data. Out of the last 8 Federal Reserve chairs, 6 successfully defended their independence: Martin, Volcker, Greenspan, Bernanke, Yellen, and Powell. Only 2 failed to hold the line: Burns and Miller. That means historically, there is a 75% probability that a Federal Reserve chair will successfully resist presidential pressure and maintain a disciplined, independent policy track. The historical winners all shared a specific set of traits: deep market competence and an extraordinary capacity to withstand extreme personal and political stress. If a chair lacks either of those qualities, the institution crumbles. So where does that leave Kevin Warsh? Warsh's market competence is completely undisputed within the financial industry. He has a profound institutional background and served as a crucial governor during the 2008 financial crisis. The core issue is that he is stepping into office to face an administration that is far more organized and aggressive than anything seen in modern history. Powell spent 4 years learning how to tune out executive branch pressure, but Warsh was taken straight to the White House for his inauguration on day 1 as a direct demonstration of political expectations. The core macroeconomic question of our time is whether Warsh will hold that 75% historical line if he maintains his hawkish roots, resists rapid rate cuts, and prioritizes protecting the dollar. Interest rates will stay higher for longer, the US dollar will strengthen, and gold will face significant short-term resistance. If he breaks under the weight of the White House and the $39 trillion debt bomb, rushing into aggressive rate cuts to monetize the deficit, the US dollar will enter a structural decline, and gold prices will immediately launch into an unprecedented bull run. The final outcome does not rest entirely on Warsh's personal resolve. It rests on the sheer math of the U.S. debt crisis and how much longer the global bond market will tolerate it. This leads us to the fourth layer, connecting every single piece of this global puzzle. Russia's $4.3 billion gold liquidation is absolutely not the trigger for a global central bank sell-off. The smart money in institutional finance understands that this was an isolated fiscal survival mechanism by a single state under extreme wartime economic sanctions. Not a strategic structural pivot away from gold, but the real value of tracking this gold sale is noticing the exact macro environment in which it took place. It unfolded at the precise moment the White House stepped up its campaign to force the Federal Reserve into a massive monetary regime change. Think about the incredible forces colliding right now. One of the world's largest commodity-producing nations is forced to liquidate physical gold to secure immediate fiat liquidity, while the leadership of the world's largest economy is actively trying to dismantle central bank autonomy to force interest rates down. You have physical gold supply moving out of necessity on one side, and global fiat currency devaluation being engineered on the other side. When these two massive structural trends slam into each other, the immediate result is a highly volatile, compressed trading range where gold gets trapped in the middle. Looking directly at the technical charts, the recent price action reflects this macroeconomic tension perfectly. Gold has been consolidating within a tight, well-defined horizontal range. On the surface, the short-term trend looks weak, but every time the price dips, it meets an absolute wall of buying support. If you look closely at the underlying volume profiles, buy orders are quietly stacking up at the bottom of this range. The distribution of trading volume has systematically shifted downward, meaning institutional accumulators are stepping in to absorb the selling pressure without chasing the price higher. This is an incredibly strong accumulation signal, showing that large-scale buyers are quietly preparing for the next major structural move. Unless a sudden black swan event breaks the equilibrium of this consolidation range, the probability of an upside breakout is fundamentally higher than a breakdown to the downside. To summarize everything we covered today, Russia's $4.3 billion gold sale is not a sign that central banks are abandoning the asset. It is the reality of a sanctioned economy liquidating its balance sheet to fund an ongoing conflict. This event on its own does not change the structural long-term value of gold.